All right. Crude oil and market making. Today we're going to talk about a strategy. I'm going to use crude oil as an example, but it's applicable to many other futures markets. I'm going to talk about a strategy that I would say 99% of guys and girls out there have not heard of, but I'm going to show you that while it's a professional level trading strategy, one I've seen played out in many prop firms, it's one that's not that hard to understand. Probably hard to master, like anything, but the basic concepts here we're going to talk about. And we're going to talk about, I'm going to show you actual trades in crude oil. I'm going to show you it playing out in the crude oil market right now. And I'll also talk about what you need to execute this strategy. So it'd be really interesting. If you're listening to this on the podcast, you're not obviously looking at me, but there's only going to be a couple of images that I'll show you. And they'll be in the podcast description, so it's fine. You don't have to watch your phone as you're on the train or in the whatever. It's fine. You can listen to this as a podcast or watch it as a video. But anyway, let's get started. Interesting graphic. There it is. See, told you. All right, crude oil. Let's backtrack a little bit and talk about futures. So some people I know trade crude oil, but not under a futures account. They might do it as a CFD, as we call them here in Australia, or other types of products, OTC, spread betting, or whatever. This strategy is a futures trading strategy. It's not just a crude oil strategy, but it is a futures trading strategy. Let's talk a little bit about futures just for a second. So futures contracts have, like options, have expiry dates. So it's not a perpetual contract. For something like crude oil, for example, they have monthly expiry. So when you see crude oil quoted on the news, they'll generally quote the front month news. When you see crude oil quoted on your trading platform, you'll see specific months. So there might be October, November, December, January goes out, I think, for crude oil. Actually, I don't know. I think it's about 40 months you could trade. Something like a bond, a treasury bond, for example, a T-note, they tend to have only one. They trade on the quarterly expiration, but they tend to have only one active contract. And then when that expires, people start trading the next and the one after that. September, December, March, June, September, December, and so on and so on. Different markets have different expiry months. Now, the process of those traders moving their positions from one month to the next is called rolling, right? So that's what we're going to talk about today. We're going to talk about the rolls market. It's not officially called the rolls market. It's not officially called rolls week, as some people call it. That's an unofficial term, but it explains what's going on in the futures markets during this process. If we look at something like crude oil, as I mentioned, they have monthly expirations. It's now September. The October contract is about to expire. So what's happening with most traders are trading the October contract right now. But they're in the process of what we call rolling to the next contract, the November contract, rolling from October to November. If you're just trading outright crude oil, you're just trading direction, that's fine. It's actually not that important. If you're trading futures, that means you just have to change the ticker on your trading platform, and that's it. That's your process of rolling, if you like. But if you think about it like this, think about let's say a hedge fund that has a large long position in crude oil, and they're long for the long term, if you like. So they've bought, say, 500 contracts. They're long 500 October contracts. Now, October is coming up to expiry in about a week or so. It will no longer exist. They have to move that contract to November, right? So what do they have to do? They have to sell their current contract. They're long, remember, so 500 contracts. They have to sell October and buy November. Sell, buy, right? That's actually a spread trade. So buying one and selling the other, selling one, buying the other, that's a spread trade. So for a large hedge fund that has just a single long outright position, they have to enter into a spread trade just to what we call roll the position. Okay. Now, this plays out every time expiry comes around, and it plays out differently for different markets. In futures markets, there's two types of, broadly speaking, there's two types of contracts. One is what they call cash settled, and the other is deliverable. So the cash settled contracts like the S&P 500, the E-mini contract, for example, on expiry day, if for those people that are still holding contracts, it's cash settled. They don't give you 500 different shares. Okay. So whatever you've bought it at, or whatever the settlement price is from your last mark-to-market position, we'll get into that on another video. But essentially, the value of your position is cash settled. Now, there's other contracts that are deliverable. Things like grains, for example. So there's a term what they call the first notice day, FND. Right? So all speculators like us are long out of those markets before first notice day. Why? Because after first notice day, those contracts become deliverable, and none of us want big sacks of wheat or corn or soybeans or whatever in the garage. Okay, so those contracts that are cash settled, they just expire. We move on to the next contract. For those that are deliverable, we move on to the next contract before that first notice day. Now, what happens before either of those dates is that this whole process of rolling goes on. So all of those big fund managers, all of those commercial hedgers, anyone who has a position that needs moving, all the treasury departments, all of that, they all have to roll their position. Okay. I've got here on the screen two charts. This is the October on the left, November on the right, crude oil. They're pretty much identical. They're almost the same. They're only a month apart in terms of its delivery period, so there's not going to be much of a difference between them, particularly since October is about, as I said, is about to expire. So what does a hedge fund manager do when it comes time to rolling his October into November? He could do it as it's two transaction. Get on the platform or call up Mr. Broker and say, please sell October 500 at market, whatever. He'll get his price and then do the opposite in November. Please buy 500 in November. All right? That's the simple way to do it. That's the way a lot of kind of people still do it, but they shouldn't. There is this thing called the spread market. Now, the lovely people at the CME and several other exchanges offer essentially a price for the differential between one contract and the next, a spread price. Okay, so quite often, for those of you who are not familiar with spread trading, if you traded options before, you already know about spread trading. Bull call spread, ratio spread, bear put spread, all of those things. With futures, it's less common. It's more of a professional domain strategy, but again, it's not that complicated. And in fact, it's quite often a much smarter way to go about it, and it is accessible. So I'll get off my soapbox there. But if you're familiar trading with other contracts, you might think of spread as the difference between the bid ask. We're not talking about that right now. We're talking about the spread difference between two contracts. So here, as I said on the screen, I've got, what are we looking at? October, November. Okay. So the spread between October and November, we're talking about that spread price. Because if you think about it, the hedge fund manager selling his 500 and buying the other 500, he's selling the spread, right? So he's calling up the broker and say, sell that one, buy that one. He's transacting in a spread contract, a spread strategy, if you like. And then the end result would be he has the long position in November. As I said, the nice people at the CME have created a spread market for us to do this in. So instead of having two transactions, it becomes one. Here's a nice little picture of it. On the left side here, we've got the depth of market for the spread price between October and November. Buying one of these means you are essentially buying October, selling November. Selling one of these means you are selling October and buying November. I know that's a bit funny to get your head around at first, but it's really, it doesn't get more complicated than that. So a lot of what I've done in the past is traded these kind of spreads more as a positional trade, a longer term trade. So further out from expiration, we look at certain trends and patterns and statistics and so on that where we trade those, and hold that type of position, hold a spread, being short one and long the other, for a longer period of time, longer term position trading. What we're looking at here is a little bit different. This is the spread market as we come close to the front month expiration. Now, what I mentioned before was this, some people call this rolls week or roll period. And I'm going to talk about what that is. Well, essentially, what happens during this roll period is that there's a heck of a lot of activity from those hedge fund managers, from those treasury departments, from those commercial hedgers, from all those people that need to, we need to get out of our position and we need to move on to the next contract. We need to get out of October. We need to get into November. Does that make sense? So we could do that the hard way, like I just mentioned before, the two-part way, like I mentioned before, or we can use this thing called the spread market. So what's really interesting here is, I don't know if you can see that close. If you can zoom in, that's great. The depth, the amount of volume going through this spread market at the moment is extremely high, higher than normal, because of all this activity that's going on. Now, there's several types of participants here. Right? One is, as I mentioned, commercial hedgers, fund managers, all of that kind of stuff, doing their thing. They're in there with a purpose, right? But there's also the market makers in there, the professional traders, the proprietary traders that have built little algorithms or can be doing this manually. We'll show you how to do this manually, but it's also an algorithmic style strategy, or mostly an algorithmic strategy, where they're providing essentially a two-way market. They're essentially on the bid price and on the offer price all day long. You can see here, see that chart there? That's just above me. That is, as I said, that's the spread price between October and November. This little area here, let me get me out of the way on the bottom right. Wait, there we go. So you can see this little, it's not a histogram here, it's the volume from the previous day's trading. So this is a 5-minute chart. The spread prices ranged from 22, little peak up to 27, but it's mostly traded between 22 and 24 cents. Now in crude oil, that's $10 per contract per cent, right? So it's traded mostly a $20 range. If you're trading crude oil outright, most days it can be up to $2,000 range. Take a look at your average true range on a daily chart and you'll see what I'm talking about. This one's trading $20, not $2,000. So you might say, well, that doesn't trade much. Well, it does trade a lot. Imagine if you could all day sit there and buy at 22 and sell at 24, 22, 24, even 23. Buy at 23, sell at 24, buy at 23, sell at 24. Keeps going, keeps going. That's what a market maker does. In the old days, they were called local traders. Now they're called market makers, and they're essentially there to provide a two-way price. And that's what they make their money from. They provide, they're liquidity providers. Right? Now, these aren't some special people with special licenses or anything like that. You can be a market maker today. You can start today doing this strategy. All right? We'll talk about the downside of it in a second, but because there's, every strategy has its downside, right? But this strategy, you can see here from the last day, if you were buying at 20, if you had your offers in at 23, or your bids in at 23, your offers in at 24, and you were getting set, make money all day long. It went against you, 1 tick on the downside and 3 ticks on the upside. $30 on the downside, on the market went against you on the upside, $30. So would you do this with a one lot? Well, that's what you'd be making, the $10 if you're doing it with a one lot. No, you probably wouldn't. You'd want to do it with a 50 or 100 or that kind of thing. And that's what all that volume is. So at the moment on the bid, we've got 3,100 lots. On the offer, we've got 2,800 lots. One price down, there's over 10,000 lots on the bid. So we're not the only people to think of this. They're already in there doing it. Right? So the trick is to obviously be at the market open, get in faster than them, chances are you're not going to do that. There are algos that are just click a button and the orders are in there. You're not going to get there. But you can get that little bit of movement. So if you're taking a little bit of that market risk. So no matter where you were in the queue, at 23, you would have got filled last night because it traded down to 22 and back up again. So it's a strategy that I think it's easy to understand the first time around. I don't know if I've gone through it too quickly, but the basic idea is think of it this way. The other day, it's not even here, I bought a new phone cable, okay, on eBay. I paid $2.99, which includes postage. So for less than $3, I get a phone cable and postage, right, delivered to my door. Now, who wants to be in that business? Who wants to be the seller? Half of you probably would have said, well, I don't want to do that. The other half would have said, well, depends how many you can sell. And, on eBay, it often says, sold 40,000 of these things or something. Now, if you're that guy that can sell, you might only be making 50 cents from it, but if you can sell 40,000 of them, then it might be worth doing. He's a market maker, the guy that I bought that off. He's buying them at, say, his cost might be $2.50 and selling them for $3. That's no different from this. It's no different from this crude oil strategy. And again, it's not a crude oil strategy uniquely. It is the strategy for futures markets that will roll to the next month when the contract expires. So look, the downside is this. The downside is that markets can get away from you. I mean, let me just go back a couple of days. See that there? Still only ranging 19 cents to 28 cents. So if you're doing it with 500 lots at a time, it can get away from you. But for the most part, as we get closer to expiry, that little range has got tighter as well. And you can see now why there's so much depth, why there's so much volume sitting, say, at 20 on the bid, at 21 on the bid, at 22 on the bid. That's because, well, there's not a heck of a lot of chance of the spread getting through there. On the upside, there's a little bit less depth, 4,000, 5,000, 5.5, 5,000, 3,000, all on the offer. So there's a lot of people in there doing it, and that in itself says, well, this thing's not going to move too much. And how far did it move last night? Well, what did we say? It went from 22 to 27. 5-tick range, 6-tick range. That's essentially the roll strategy. Now, I've known people to trade this and only trade this strategy. So before I entered the world of prop trading about 10 years ago, for me, expiration as an options trader, well, that we trade a lot around expiration. But as a futures trader, it would be the only expiration style trading you would do is like, I've got to be out of this contract, I've got to be trading the next one now. That's the extent of your strategy. In the world of prop trading and all this algorithmic stuff that's kind of followed it, this strategy is a whole lot more dominant, if you can say. It's a whole lot more popular. I've known traders that say, I don't trade rolls week, it's too hard, that's my holiday time, I go away. I've known other traders that say, I only trade rolls, that's all I do, I just mess about, I do my other job during non-rolls period, which I think is really interesting. The reason, one guy might say, I don't trade rolls is because he's used to a strategy that works when the market's not going through that process of rolling. Because the market, volumes can change and the nature of the market can change a little bit. And the guy that says, I only trade during rolls is because he likes that certainty. He likes that simplicity of a market that has a 2-tick range, a 3-tick range, a 4-tick range. Most of us, right? Most of you getting into trading will look for those explosive things. Think markets like crude oil and gold and the S&P that move about and go crazy and, this is where you make your Lamborghini money, all that. But once you get into the realm of professional trading, you'll see that kind of stuff is nice, but that's not what you really go searching for. You go searching for a lot of these, they might call them mean reversion trades or trades that, tight range trades. I've known plenty of people that say, I don't like volatility. I just look for when it's doing this stuff, I'm out. When it's doing this stuff, That's where I'm on the offer, I'm on the bid, I'm on the offer, I'm on the bid. And that goes for algo traders as much as it does click traders, manual traders. And so the good thing about, the reason I've used crude oil is for this example is because I think it shows you the potential upside of it in the sense that, say, last night, for the most part, that spread traded 23 and 24. Right? So if you could get filled on your orders at 23, 24, you're making money. Fine. Right? Occasionally traded at 22, occasionally traded at 25, 26, and a little bit at 27. You can see that on the chart, right? That's up here, just here. So there's your days range there. Most of it was 23, 24. That's, some traders like that predictability, and why shouldn't you? Why shouldn't you like that predictability as a strategy? I find it really interesting. Now, of course, as I mentioned before, this style can easily be automated if you go down that path. I won't talk about that, but you can see that once you get into a simple rules-based system, then you can program this into something like Xtrader, TT's Xtrader or whatever, and build it as an algo. But I like the idea of understanding it as a manual strategy. If you're trading your one lot, making $10 each time, you're not going to be making a heck of a lot of money on an hourly rate unless you can just get filled over and over again. But it's something that I think is a strategy for, I suppose, a lot of new traders that have started to understand depth of market trading, that have started to get their head around spread trading a little bit, and know with this strategy, the real challenge is, not, say, managing wild losses or anything like that. It's not really going to happen. The challenge is to get filled. So if we went and put orders in now at 23 and 24, we've got, about 3,000 people in front of us, or 3,000 contracts in front of us to get filled. That's not to say we won't get filled. You can see today, for example, price at 24 has traded 46,000 times. The price at 23 has traded 32,000 times. So there's potential to get it done, but it's how often you can kind of keep repeating that strategy, if you like. I suppose that's what your algos are for, but that's another video. The reason also that I brought it up in crude oil is because crude oil has monthly expirations. So these rolls weeks happen every month. It's not even a week, it's a bit more than a week. So this whole process happens every single month. So should someone go down this path of focusing on that strategy, the crude oil market is a good market to do it in because you're doing it so frequently. It happens in treasury bonds as well and other bond markets. They tend to trade on a quarterly cycle, so it only happens every quarter. Same goes for short-term interest rates, things like Eurodollars, every quarter. Okay, so other markets like grains, for example, that can be a little bit trickier because there's new crop versus old crop considerations, but it still happens anyway. It's a little different dynamic there. But something like crude oil, which doesn't have a crop cycle as such, or treasury bonds, which are just treasury bonds, then it's more, I think it's more, I'd say viable, I'll say a strategy that you can understand a little better. Now, if we were to be writing this out as a cooking recipe, there would be a few things you would need as ingredients to actually trade this system. Now, strategy. If you've not traded futures before, then you'll need a futures trading account. Okay, as simple as that. But what I found quite difficult for retail futures accounts, and this doesn't happen at professional level trading, but retail futures accounts, a lot of brokers won't offer this spread market, this thing here. I'll move myself over to the right again. Okay, they won't offer the spread market. So you have to, some brokers will offer spread trading. They'll give you a bid price and an ask price for a spread, but they won't give you this spread market. For some reason, they don't make it available. Right? Point number one. Number two is a broker needs to provide what they call span margins, S-P-A-N. Can't remember what it stands for now, something array, something or other. But it's when you trade futures, you pay a margin. It's a deposit. Think of a deposit. When you trade spreads, your risk is a heck of a lot smaller, right? We've just seen this is a heck of a lot smaller. A span margin means the broker is charging you a smaller margin. Some brokers don't charge this. They charge you the full super duper margin. So when wanting to trade this strategy, you need a broker that offers span margins, essentially margins for spreads. That's the question to ask. And you also want to ask them, do they have the spread market, the exchange spread market? And you almost have to ask them for a picture of their platform with it, because even a lot of brokers don't get that this thing exists. They don't know, which I find friggin' amazing. I don't understand. They should know. Maybe they pretend they don't know. But it is very hard to get a combination of the two. I would say probably 1 in 5 or maybe 1 in 10 offer that. So you need to ask around. You need to shop around. I know a few brokers that do that. You can email me privately. We'll talk about that. But I'm going off. So that's something that you need to have that in place. Then this strategy is potentially viable. But anyway, look, I didn't want to rattle on for too long. How long have we been going? 25 minutes. This is a relatively simple strategy, in my opinion. It's like the guy buying his phone cables and selling them on eBay. He just wants to do it 40,000 times and make his 20 cents, 10 cents, 5 cents, whatever it is. Just do that so many times. And if you notice, that's what eBay's become, right? A lot of people do that kind of thing now. Everything is, really cheap and sold X many thousands of times. But it's a relatively simple strategy. Just because it's called crude oil doesn't make it more complex. Buying at 23, selling at 24 makes you $10. Just do that 100 times. Just do that 500 times. You know the risks. The risks are bleedingly obvious. The risk is the market can move away from you, just like any trade. But here you can see that volatility is relatively light, significantly lighter than trading, say, outright crude oil. Outright crude oil, trading directional stuff by comparison is hit and miss. Your system might have, 55% strike rate or whatever it is. It's still hit and miss. Whereas this strategy, when you lose, you don't lose as much. Obviously we'll have a higher strike rate should you get into the market, should you have your bids and offers there. So it doesn't come without its risk. It doesn't come without its difficulty. But I think you'll agree that it's a strategy that's certainly viable. Right? But you need those things in place. You need span margining. You need the access to the spread market. Something to ask your broker or email us about. Anyway, so I'm trying to stop rambling now. That's about it. I hope you like that one. I think it's a really good strategy. It maybe is a little task. Any other market that you're trading, if you're trading in crude oil and natural gas or whatever, have a look at the spread market. Have a look to see if you can see those kind of trades. It's just a little kind of a little bit of homework for yourself. Have a look to see if that's how the market behaves leading up to that week of the either expiry for a cash settled market or that first notice day for a physically settled market. Okay, something to have a look at. Shoot me an email if you have a question too. But let's finish up. 3 things to do before you go. Subscribe and click the little bell in this YouTube video. Go to my site, TradeArian or masterclasstrader.com and sign up for the email newsletter thingy. Also check out my DOM trading skills where you learn all about this stuff. And spread trading where you learn all about the spread trading course where you learn all about this stuff, that spread trades. So take a look at that. Pardon me. In the masterclasstrader.com site, have a look at, there's a link up the top that says specials. Believe it or not, that's where you find current specials. Funny that. And good trading. Happy trading.